Hello everyone and welcome to today's webinar, Demica Insight Q2 2021, The Times They Are A-Changin'. Before we get started, I would like to go over a few items so you know how to participate in today's event. The audio for this presentation is through your computer's speaker system. There is no dial-in number. All attendees are in listen-only mode. However, you will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We'll collect these and address them during the Q&A session at the end of today's presentation. Today's webinar is being recorded, and you will receive a follow-up email within 24 to 48 hours with a link to view the recording. I would now like to introduce Demica's Chief Commercial Officer, Maurice Benisti, to begin the webinar.
Thanks a lot, Dan. So thanks everybody for joining us. I'll start by making some brief introductions of our panel. So we have, fortunate to have with us Casey Talbot, who's the head of fixed income at UBS O'Connor, part of the asset management arm of UBS, who's spearheading a move into working capital finance across a wide range of products and geographies. Bart Raz, managing director of Pemberton Capital Advisors, a fast-growing asset manager operating in a variety of credit markets, who as well are increasing the resources devoted to supply chain finance. And our very own Adam Barrett, head of distribution, who prior to Demica held senior management positions at UBS, Goldman Sachs, Barclays and Lloyds, with responsibility for institutional sales across a wide range of products, money markets, foreign exchange, interest rates and credit products, to name a few. Just moving on to the agenda, I'm going to spend a little bit of time talking about what we're seeing in terms of the industry data and associated commercial activity. So what we're seeing in the market around certain industry sectors. We're then going to take a poll from the audience, and then I'll hand over to Adam, who will discuss with Casey and Bart what they're seeing in the market as they grow their business in the trade space, and an interesting and exciting insight into the growth of two important alternative investors in our sector. So now if we can move to the next page. So just a brief reminder of what comprises our platform data. We have around 500 sellers, 1 million debtors across a range of different working capital solutions, approved payables finance, trade receivable securitizations, and receivables purchase programs. And this data is a subset of our total data set, where we adjust and scale back where appropriate to make sure no sector is unduly influenced by the performance of any single client. We strip out new business development in the year, so we're really comparing like for like. And we indexed the numbers to January 2020 when we started tracking the performance. So it shows a pretty interesting look at what's happened through the pandemic, through the onset of the pandemic and now the recovery. Next page. So IT, it's a familiar story to those of you who've joined us for prior sessions. We saw accelerated demand in 2020. It's continued in 2021 as the shift to home working and associated demand for hardware, peripherals, and software continues to run. And we don't see any signs of that stopping in the industry data that we follow. What you do see, which is notable, is a divergence between the payment terms and collections, which we think reflects customers paying down balances early to create credit capacity for further sales. So all the signs of a sector that continues to boom. Next slide. Merchant wholesalers, you can see that there's been a sustained recovery from the low point in Q2, and we're seeing that customers are now starting to reignite plans for approved payables and receivables finance programs that were perhaps put on hold in 2020. So an uptick in new business development. We're hoping to close an important transaction in the quarter for a sponsor-owned company that operates in this segment and needs working capital to support growth. Next. Automotive continues to retain its momentum as Europe's come out of lockdown and perhaps spend been reallocated away from traditional discretionary spend areas such as travel and leisure, and people have been increasing their investment in vehicles and buying cars. And from a customer perspective, what a change, right? You can see the change in the average aging balance has improved significantly, and whereas customers were asking for flexibility around triggers on securitizations, we're now hearing that they're awash with liquidity. In some cases, we've seen, in one case in particular, we've seen a customer cancel or downsize, looking at cancelling or downsizing a facility. So a complete turnaround relative to last year. And finally, looking at paper and packaging, I think, Dan, you want to go down one? We are seeing demand really accelerate to levels that go beyond what we expected, and what our customers are telling us is that this just continues to be the macro trend of moving away from plastic to cardboard and e-commerce. So again, I don't think, in a sector that was historically pretty stable, we didn't expect to see this in 2021, and you see an accentuation of a trend that was set off by the pandemic. Next slide. So we've pulled out some of the insight that we get from following the trade associations. So you can see that in 2020, for the full year, receivables finance, as reported by FCI, fell 6.5%, which was slightly worse than GDP performance. And what we'll be telling is, of course, what happens next. So the survey that they ran showed that half of the audience were positive for growth next year, and of the balance, 42% were neutral. So you've got an industry that is optimistic for the future. And if I look back to 2009, when we moved past the financial crisis, you saw that big overshoot in terms of demand that resulted when that finished. This is a very different downturn, was a very different economic cycle, but still, let's early signs, and again, what we're hearing from the market is that may well repeat for 2021 and potentially further. Next slide. So I thought this was interesting because if you look at some of the trends in the data, you see that 2020 really accelerated what was already happening. Your reduction in volumes for invoice discounting, recourse factoring, whilst non-recourse factoring in fact grew in 2020. Again, very consistent with what we hear from the market. And we're seeing certainly increased activity with larger companies who are looking for these types of solutions. So for the factoring market in particular, which was very focused on the SME market, larger deals continuing to play a part as the market evolves. And finally, move to the next page. In the US, the SFNet data shows certainly a recovery in terms of the underlying credit metrics and percentage of non-accruing loans as a percentage of those outstanding. So credit metrics have returned to normal. New business development is improving, although not quite back to not quite back to historic average levels, but utilization is really low. And from what we hear, again, just a lot of liquidity in the market as government initiatives and a recovery in the economy kind of powers through. So I'm not, too early to call whether those trends continue and eventually those government programs end, but certainly positive from where we stand now at this point in the year. So with that, I'm going to hand over to Dan, who's going to, I think, launch a poll, and then over to Adam, who will get into the discussion with Casey and Bart. So Dan, if it's okay with you, I will hand back to you.
Great, thanks, Maurice. Hopefully everyone is seeing the first poll in front of them at the moment. Essentially, the question is, what best characterizes your outlook for full year 2021 revenue performance compared to 2020? The options, as you'll see them in front of you, are whether it will be significantly improved, getting back to pre-pandemic levels, whether you expect a moderate improvement, but not quite yet back to pre-pandemic levels, or finally, whether you think there's just still too much uncertainty to make a full year 2021 prediction. So as we collect some of those responses, I can see some of those coming in. We really appreciate your input, and it'll be certainly useful to guide the discussion for the rest of the session. We'll give you a few more seconds to put your answers in, and then we'll be closing the poll in around 5 seconds. I can see nearly 60% of you have voted, so we appreciate that. Great, thank you. And if I close that and share it, hopefully you can all see those, and I'll hand over to Adam to discuss some of those poll results.
Yeah, interesting to see. Thanks, Dan. Interesting to see how the poll comes out. And you know, I would say plenty of people still too cautious, and yet for those making a prediction, significantly outnumbering those only seeing a moderate improvement. So the economy is not roaring for sure, and that's reflected in our attendees and their view on revenue for this year. Thanks. Now, before I go on to just share a couple of slides, I just wanted to introduce the distribution function at Demica. We're a team that maintains a dialogue with funders of working capital deals to enable us to target the right counterparties for financings that we're mandated to source funding for. This includes both the 35 funders of transactions for which Demica provides services currently, and approximately another 150 funders where we've got non-disclosure agreements in place and who've indicated the capacity to fund appropriate transactions for them that Demica might bring to them. So that's just a brief description of the role of our team. Now, historically, this is a business that's been dominated by banks, along with the factoring houses that many of you will be familiar with, a lot of whom, of course, are the subsidiaries of large banking groups with significant trade and working capital financing operations. They sit these financing activities typically within their trade finance operations, although the securitization of pools of receivables, which has been a growing trend over the last few years, is often undertaken within their debt capital markets businesses. But we're not here to talk about the banks today. We're here to talk about those non-bank funders who are starting to become more active in investing in a range of transactions encompassing both what you might call vanilla receivables and payables financings, for some of the categories that Maurice shared with us earlier, but as well as receivable securitizations. Now on slide one, the slide that's up on the screen here, what I've attempted to characterize is the number of non-bank funders that Demica talks to, over 80, as you can see in that pie chart on the left, broken down into a number of different categories. We'll talk about some of those a little later on, but asset managed groups of a variety of types forming the largest single grouping there. Demica does speak to a number of factoring houses, but only in active dialogue with a limited number of the larger ones. And on the right, you can start to see the sort of geographic representation of these non-bank investors. And it won't surprise you, I think, to learn that the UK and North America, given that they're the biggest homes of asset management and investing businesses generally, also represent the most significant geographies of organizations where we seek to talk to those investors. But importantly, they can look at transactions in their own geographies as well as across a broader set of areas. If you can move to the next slide now, please, Dan. So why are these investors getting involved in working capital financing? Well, it's part of a broader trend, a trend to invest in private credit, a phrase I'm sure many of you have heard more generally, and seek to capture the illiquidity or complexity premium that private credit assets can offer over more liquid traded securities. So that's the broader trend. The more specific trend is that working capital financing, unlike many other assets in the private credit asset class, are much shorter in duration. So you'd expect to see receivables or payables for financings be something like 90 to 180-day type of maturities. And that contrasts with the much longer maturities for infrastructure loans, for example, or leverage loans, which are other key components of the private credit asset world. So I think that's one of the reasons why it's been attractive. But I think one feature that we've certainly noticed in our engagement with organizations in this area is that working capital financings can be structurally more complex than other forms of private credit, and certainly specialist investors are those that are going to be the most responsive and easiest able to analyze the opportunities that we present them in the working capital world. Just the last slide now, please, Dan. So these investors are different from banks, and we've sought to highlight in a fairly sort of generalist way, if you like, some of the key differences. I won't go through the slide as a whole here, but some of the things I would highlight is that some of the positives of working with non-bank investors is that they can often consider types of credit risks that banks are less comfortable with. They can often move more quickly, and speed can be important in the closing of certain types of transactions. They're clearly a diversifying source of liquidity to the banks that funders may normally seek to use. And I think also importantly, and this has been true particularly through the pandemic crisis, an existing relationship is not a necessary precondition for non-bank investors to get involved in providing financing for a transaction. There are some things about working with non-bank funders that leave them sometimes disadvantaged compared to banks, and I just highlight a couple here. Often the level of resourcing that they've got in place to support transactions is understandably less than sitting in a large trade bank, and that can create capacity constraints in terms of their ability to review and analyze deals. And sometimes they don't have all of the resources necessary to sort of make a fully fledged proposal on a transaction, preferring to receive something that's perhaps a bit more pre-packaged, if you like, in terms of the opportunity that might be presented to them. But these are really generalizations that I'm making here, and rather than talking in those terms, I think it's really important to hear from two investors who are increasingly active in the asset class, which is why we pulled the panel together. And so I wanted to turn now to ask some questions of our panelists. I think for now, Dan, if we remove the slides so that we can see Casey and Bart in more glorious and bigger size, if you like, on the screen. So the first question I wanted to just get your thoughts on, or understanding really, is about the sorts of transactions that you as an organisation really like to do. Where's your area, if you like, of focus in terms of deal type, or whatever flavours you'd like to share about that with our audience today. Casey, can I ask you, first of all, a little bit about the sorts of transactions that, at least within UBS O'Connor, that you find interesting to consider in the working capital financing world?
Sure. Thanks, Adam. And thanks, everyone, for joining. Our mandate is unconstrained. So we are a hedge fund structure, which means we touch everything already at our institution, from investment grade to non-rated in the credit space, both public and private. We just make sure we have to underwrite everything and we get comfortable with that obligor risk. So we've done everything from investment grade rated SCF to non-rated private company, small revenue, small EBITDA, AR and SCF. And again, we'll do AP, SCF and AR. I think you had the point earlier that there's, unlike some of the bank constraints, which have their virtues, we don't have any constraints, and our investment committee is one level up. So we don't have risk charges or credit charges. So it's really wide open for us. I think geography is probably a more important question for us, and we just want to make sure we operate in countries that do have rule of law and do have a bankruptcy process.
Fantastic, that's really clear. So really quite an unconstrained universe from the credit spectrum perspective, but geography is linked very much to what you might call perhaps more mature markets from a legal framework perspective, is what I've understood. Thank you. Bart, over to you in terms of the things that Pemberton are looking at. What would you highlight for our audience?
To avoid repeating many things that Casey said, because many of the things he brought up are also true for Pemberton, to add to that, we're always looking for the right risk-adjusted returns for our investors. We do work both with insurance and non-insurance. Sometimes the deals itself come with insurance, sometimes we source it ourselves, and that's just to optimize actually the risk-adjusted returns. We focus on the full suite of working capital solutions, so from payables, purchase orders, payables, inventory, and receivables, that whole suite. From a duration point of view, we do not go much over 180 days. In some very specific cases, yes, but generally it isn't a payable or receivable. It's becoming much longer than that. And from a credit perspective, indeed, everything single B upwards is looked at. But as Casey said, I think that is an important element. We always do our own credit underwriting.
Okay, that's really helpful. And as I can see, some overlapping in the responses you've given, as well as some specific and unique points. Now, Demica obviously engages with you as organizations and talks to you about transactions that we're working on, but by no means do we see all of market. And so I'd really be interested to get your perspective on some of the themes and flavors, if you like, about transactions that are coming across your desk in the current environment. So it'd be good to learn a bit more about the nature of the deal flow that you see and the sorts of organizations that might bring you that type of opportunities. Demica is obviously the best at doing that with you, but there'll be other organizations as well. So Casey, turning to you again first, talk a little bit about the deal flow that you see and where you source, if you like, transactions from.
Yeah, similar to what we do in the public markets, we're open architecture. So we source from banks, from fintechs, from ERPs, from independent brokers as well. So we want to cast that net as wide as possible, and the more opportunities you see, the more judicious you can be, and the more optionality you get at the end of the day. We definitely saw a spike starting last year. I think again, as banks got lines drawn, we were able to have our signal out that we were open for business. And so we've seen a continual spike from there. And even on the heels of, Greensill, we were able to participate in some of that capacity, and we saw some, spikes from there. And again, we continue to expand that network as much as we can. And again, want to just have as broad a net as possible. I think the flavor of what we see is the banks tend to have more higher quality and have more sort of your Fortune 500 type of opportunities, less as you go down that risk spectrum. And that's where you tend to see folks like Demica and others who can provide some really creative solutions for those companies, which is probably out of the purview of the banks, either because of credit risk limits or the fact that they're looking at, potentially what other reciprocal business they can do. And again, as you get to those smaller companies, you're not getting the M&A underwriting, you maybe aren't getting the ABL, you're not getting the debt or equity underwriting as well. So we really like that entire spectrum and like what we see across all of those originators.
Casey, thank you for that. Paul, let me turn to you. What would you say about some of the themes you're seeing in transactions, perhaps over the course of this year, and a little bit about how you go about sourcing deals to build a Pemberton book of business?
So sourcing is very similar to what Casey just said. We do direct origination ourselves. We work with introducers. We work with fintechs, and we also work with banks. The way we go about is also we're trying to bring similar or even better solutions that were normally only out there for the investment grade companies, actually bring them to the underserved middle large companies. They are generally very appreciative if you actually give them access to great solutions that they would normally not have access to via their banks for all kinds of reasons. From a market segment and from an industry perspective, generally working capital becomes highly important if there's a big shake up within an industry. That can either be a slowdown or an acceleration. Guess what? Both of them we had in the past 18 months. Some of them are still slow. Some others came to a grinding halt, but then accelerated like crazy. And others actually were just booming right out of the door, for instance, with IT. So we see a lot of IT distribution needs. We now start to see an awful lot of auto requests. Retail has been strong for the past 1.5 years anyways. So you can almost see at the economic swing a certain industry is at where the demand will be coming from. And guess what? That also helps us to focus on those particular industries where we simply know the need will be more and the focus will be more on working capital.
That's a really interesting point, I guess, and logical, right? That as industry cycles come and go, that's going to reflect their need and appetite for working capital. It's an obvious point, but it will reflect itself in the deals that you're brought for sure. So linking into that point, I guess, be interesting to get both of your perspectives on market pricing for transactions. So we certainly at Demica saw, I guess, the sort of expected cycle of some widening of pricing into the pandemic, which was then maintained. perhaps more importantly, a withdrawal of liquidity. I think that's perhaps the more powerful phenomenon. And then the gradual grinding tighter of pricing, particularly for double B and up, if you like, equivalent risk, that's only continued through 2021. That's been our take from the cross-section of transactions and clients that we talk to. But it'd be good to get your perspective on pricing, particularly its evolution in the next 6 to 12 months. So Casey, again, back to you, your thoughts on how pricing will evolve. You may wish to talk your book and say it's going to go wider, but be interested to hear what you really think. So.
Yeah, no, I think it's, in all honesty, it really is linked to, what the overall markets are doing. So what the credit markets are doing, US, Europe, et cetera, what those spreads look like. And it's going to be a factor of that. So as spreads are widening, liquidity is widening, you're going to see pricing widen. As liquidity is getting looser and spreads are tightening, you're going to see that pricing here. We're very aware of that. So we're involved in the public markets every single day. So we understand that relative value. And in fact, we've actually moved, again, we view these as partnerships. So when we start funding with a company, we want to be with them long term, unless something changes on the micro front or the macro front. We've actually repriced tighter from opportunities that we funded last year in conjunction with the companies and saying, listen, your credit spreads have improved, or even if they don't have public debt, the market itself has improved. Now that cuts both ways. So it goes the other direction as well. The spreads widen out, and we're all going to look at, again, your credit risk premium and use that proxy. So it can cut both ways. As far as forecasting where things are from here, there's an abundance of liquidity in the marketplace. We all know there's 12 to 15 trillion of assets are trading at negative yields. We've also seen that liquidity can go very quickly. And I think that's one of the virtues for non-bank funders like Bart and ourselves is there's not a correlation between Bart and ourselves or non-bank funders. We're uncorrelated amongst ourselves, whereas the banks tend to have a very high correlation, i.e. last year, if their bank lines get drawn, that's going to impact everyone, impact pricing. Or if there's a capital change or an accounting change on how things are attributed to being accounts payable and how they need to be recognized as debt, that's not going to impact Bart or my perspective, but it will impact the other side. So I can't forecast where pricing will go right now, but I think it's always going to be anchored on what the public markets are giving us and what the absolute fixed income yields are in it globally.
That's really interesting. I just want to pick up on one of the points, Casey, you made before turning to Bart. So we've seen in sort of the quasi-public markets, leverage loans repricing down, right, in sort of these tender-like operations that have taken place. And it's interesting to hear your anecdote about, allowing a borrower to reprice tighter, if you like, in the way that you were just describing. Have you been presented with transactions at all that explicitly ratchet the pricing to levers, if you like, in the working capital financing space, as has happened in other private credit asset classes?
Yeah, we haven't, because there's not really a great benchmark.
Yeah.
At the end of the day, so it really is idiosyncratic. It's on a case-by-case basis. But again, throughout our processes, we're either dealing directly with company, or again, we don't originate directly. We'll always have someone in between us, but we'll have a dialogue with either that partner or the company itself. And again, because we're involved in the markets every day, whether it be us initiating or they initiating, we're very open to those conversations. Again, it goes both directions, though. If the market does go wider, liquidity dries up, you can get a step function, the other direction as well.
Yeah, no, that's helpful. So Bart, what's your perspective on the issues around pricing that we've just been discussing with Casey?
Let me add some different perspectives. It's very similar. First of all, I do fully agree with what just was said, to avoid that we're just repeating ourselves. That credit element in the market is just a fact. I wouldn't say these are day prices, but it's just what the market is. Then there is quite a difference whether companies do have actually access to that liquidity. One of the reasons, in my opinion, why you saw such a drop in factoring demand was that there was simply free money available from governments. We will see what starts to happen when that is being withdrawn, because it was crazy cheap money. And regardless of that was actually a loan and not off balance sheet structured, it was so cheap, a lot of companies would have made no sense to not take it. So let's see what happens if that needs to get being repaid, and how that is then filtered through into normal pricing in that segment. Furthermore, I think pricing for working capital solutions is actually based out of two elements. One is, yes, the credit. The other one is how good the solution is. How fast can you operate? How flexible are you? Can you do multiple jurisdictions? So if working capital finance was just as simple as an overdraft, then all the pricing could be published in the newspaper each day and people knew exactly where it was trading. That isn't the case. And especially for the mid-sized companies who probably don't have public debt outstanding, there is much more room to actually tailor something that really fits their needs. And therefore, you will see that the pricing can vary more compared to, let's say, investment grade companies where it is very transparent on what pricing is. And there seems to be only one direction of travel right now. So it's a bit of a mixed bag. I do fully agree that in the past year, pricing has come in, it has tightened again. But again, if you do offer solutions that others can't offer, if you have the flexibility, if you can act quickly, that actually is an element of the overall pricing discussion.
Yeah, no, I think that you both made really important points. It's certainly not all about price. There are other factors that can come to bear, and I think the distinction that was something we referred to earlier around the investment grade names where the pricing power lies more, if you like, with the borrower, to more crossover credits and smaller businesses where price can obviously be wider, but also some of the flexibility points can be really valuable to them in terms of the way that they source and obtain value, if you like, from working capital financing.
And maybe, Adam, let me make one additional point. What I come across quite often, especially if you go to the mid-sized companies, quite often, quite an element of their working capital needs is actually funded by equity, because they are not such advanced as, let's say, the Fortune 500 companies. So if you then introduce them to solutions that were available to, let's say, the Fortune 500s, you can actually replace expensive equity by injecting working capital finance. That is generally so much cheaper that isn't actually really linked anymore to what, let's say, the credit is, but actually, wow, this is much cheaper than equity. So I think that is also a very interesting element, and that's one of the reasons why we tend to focus on the underserved middle, as I would like to call it.
Yeah, Maurice, I think you've got an example of a company that did exactly that, right? I'm thinking,
Yeah, I mean, the point I was going to make was that, to Bart's point, price is important to companies, but continuity of supplies is more important, particularly when it comes to working capital. So it's in no one's interest to stand up a program where you try and squeeze the best possible price, but put yourself into a position where, because the investor has to price more to market than perhaps a bank does, they then have, kind of surprises down the road, and that filters through to their supply chain. So I think Bart's spot on. There are products that are much more service rich and where structuring can play a role, where if you can put a package together at a price that works for both parties, you significantly improve what's available for the investor relative to kind of other more liquid instruments, and that premium the company's happy to pay for.
Yeah, and I think last point that we've picked up from a number of banks that we talk to is that their capital models are themselves going through an evolution, and not really a positive evolution in respect of the sorts of financing that they're going to be able to do. I'd particularly highlight that from an advance rate perspective. So that flexibility and that liquidity provision, which may create capital charges for banks, if you like, going forward, clearly, and in fact, Casey, you were making a version of this point earlier, isn't the modus operandi or the constraints within which you work as a non-bank fund. And so flexibility can be price, it can be advance rate, it can be other aspects of the service provision, if you like, as we've been discussing. Great, thank you for that. That was a good discussion. So the couple more questions to go from my side before we turn to ask questions from our attendees. So your two examples of organizations that have embraced working capital financing, it's a key part of your strategy. That's why we're thrilled, in fact, to have you here as panel members today. And there are lots of other organisations that in a variety of different ways are entering, seeking to enter, considering entering this asset class on the non-bank side of things. And we've certainly noticed that when we speak to organisations like that, that the less specialised they are, the harder it's going to be for them to build up a significant book of business, because you do need a certain amount of resourcing and ability to understand the structural complexity and therefore do underwriting in an efficient and effective way. And that's meant that some quite high profile firms who've really looked to make a big splash in this area have not really been successful because they're not appropriately resourced. But that's just my perspective, if you like. What I'd like to do is get your perspective on what are the obstacles, if you like, that is stopping more involvement from non-bank investors in the asset class? Because, you know, although competition in one sense may not always be a good thing for you individually, the more that this becomes an asset class open to non-bank investors, the better it'll be for, in my view, all market participants. So just coming back to my question, Casey, what are your thoughts about what are the obstacles to you and indeed other non-bank investors doing more deals?
Sure, there's a handful of things. It's operationally complex, processing, you know, either directly or through, you know, a servicer, a number of invoices. So there's a lot of high volume. So it takes a resource commitment there. The other aspect I would say is that duration aspect cuts both ways. A short duration is a good thing. You could talk about the fact that it protects you from an investor standpoint in case there's any kind of deterioration. But the flip side is if you have locked up capital, if you have private capital, you actually want longer duration. So I think that turns off some investors as well. There's a lack of data and transparency, and we could say that about a lot of private credit. But you know, this sort of lives in this hybrid world. So you know, if you have middle market lending to private companies, you've sort of got a leverage loan anchor off of that. And so there's not a lot of and you know a history of defaults and what happens with a default and what happens with a recovery, and there's a series of precedents. Here there's much less of that precedent and much less of that data. So it's really sort of an opaque market to aggregate that data front. And then I think there's also variations on the legal side. So whether that be documentation or transaction, each transaction is a little bit unique. There is some, you know, among the banks, there's more commonality among those legal documentation. But each transaction, you have to underwrite from both a credit standpoint, a fundamental standpoint, an operational standpoint, and a legal standpoint. And then you turn around and say, well, your hope is that you stay into a program for a series of years, but you might not. So it might be a short duration, 60, 90, 180 days. So I think if you aggregate those issues, it just takes time, and it takes time to build it up and build it out. Once up and out, I obviously think it's worth it, but those are some of the gated issues, I think, for some firms.
Yeah, you can see both Maurice and I doing a lot of nodding. We live with a set of some of those challenges, if you like, around the deals that we both work on, for sure. But so Casey gave a really great list of observations there in terms of challenges. What things would you add to complement his perspective?
Many of the investors that are coming into this asset class are coming from the debt capital market environment, where they are used to large tickets, while actually trade are a zillion small tickets. Many invoices are actually less than 5 grand. So if you want to invest 100 million, you need to buy an awful lot of invoices. So this is where that operational nightmare potentially comes in. And that is, I think, also a very interesting inflection point right now, because to do this efficiently, you need technology. And so far, the technology was not readily available, or at least not purchasable off the shelf. So all the banks have built their own software. Some more successful than others, and most of them not that successful and hugely costly. So to enter that market, knowing that you almost have to start your own IT department next to it, is not very handy. The good news is now that an awful lot of things that you will need to get organized if you want to get into trade are now in or outsourceable or rentable or whatever you want to call it. That is a big change compared to not even 5 years ago. So therefore, this market will become more accessible for people who want to invest in this asset class. We are a long way from effectively having in transparent exchange. It will also always remain an over-the-counter type of market. Another element that will be hurtful for some countries is just the regulatory environment. In some countries, purchasing receivables is a regulated activity, and therefore it just takes more time before alternative working capital players will be active in those markets. But I think we are at an inflection point. There's an awful lot of money looking for alpha. This is an interesting asset class. It is massively big. So it is not even about competition and trying to get a part of the market that is currently within, let's say, somebody else's domain. There is an awful lot out there. The problem is getting access to it. Sometimes I compare it harvesting water by collecting raindrops. You need a different method to be successful. But those that are willing to dig a little bit deeper and understand how this market works will get access to a fantastic asset class. And a very good thing is, it is crazy sticky. Once you have done the hard work and set up these programs, many of them will just keep on turning year after year after year. And therefore, there is a high barrier to entry. But once you have done the hard work, actually, you will get the fruits of that hard work.
Yeah.
I have a question. I could jump in. I have a question on that, Bart. So we find that that's that sales cycle, an extended sales cycle from when you engage with the company, get them to make a decision, stand up the program, allow it to ramp. That kind of it can take a couple of years, right, before you.
Oh, Maurice just froze. That means one of his kids has turned on the games console, I suspect. Okay, well,
but maybe the assets that you're targeting, and that presents some.
Yeah, Maurice, I don't know if you can hear me, but you're freezing a bit, unfortunately. Are you back? Yeah, now no sound.
Well, I'll hand back over to you then. My internet.
Okay, that's technologically very wise. So thank you for those answers. Casey, did you have a comeback on that? I sort of thought I noticed you were going to. You had a thought perhaps.
Yeah, I think Bart makes a great point. It is, you're a bit of a miner here. So whereas in, again, the public markets, there's a big capital market aspect. You can go out, you can get liquidity if you want to put on risk. To Bart's point, you really have to dig here, and you have to do the work, and you have to put in the sweat equity. And again, the good thing is once you're in a program, it's in everyone's best interest to continue for that to proceed as long as possible. So it pays off, but it's not like you can hit a button or go to a dealer and say, offer me, 500 million or $1 billion of said risk. You really have to mine and work for it. And again, that is part of the nature of certain aspects of private assets that you do have to dig and work for it. And that's where your alpha does come in, is that liquidity aspect. But I think that's a good point on why that's a deterrent as well.
Yeah, I'd agree. I mean, I meet two sorts of private credit investors in this role here at Demica, and there's what you might call those with a dedicated strategy, and the tourists, to use a slightly derogatory phrase, but people who could dip in, but it's not a core part of what they seek to do. And in my view, that latter group is going to suffer a little bit from negative selection, to be honest, but also will never build a proper book of business because of the work that you've both described. I think is important to do. So my last question, and Bart did helpfully tee this one up a little bit for me, was about technology, and you mentioned, Bart, that can be a really important component of helping to make a book of business work efficiently. So I just wanted to ask both of you what you think is the role that technology will play for both of your organisations in terms of the ongoing growth and development of your working capital financing business. Casey, what are your thoughts on that point?
Yeah, I think it's been, to Bart's point, a great help on the operational side, on the processing side, as far as seeing overall risk. And because, again, we have so many payments going out and coming in, being able to see your risk as a whole, and then be able for our ops team to be able to process that. What I think you fall into danger is if you can just provide a quantitative overlay and say, if it checks X, then we fund Y. And we've seen that throughout history, that people get in trouble when they treat everything as widgets. So I don't think you can treat everything as widgets, and I don't think we're there yet, but we've seen some platforms that just want to treat everything as widgets, and it's not widgets. Every transaction is unique in its structure, and I think that's where we add value on our side, where we can be flexible. So right now it's a portfolio view. It can be a sourcing view or sourcing advantage. It's a portfolio view, and it's on the operation side, which allows it to scale, and I think allows it to asset class scale. But I'm still wary of platforms who provide a magic button that everything's a widget. Again, we've seen how that's worked out throughout history if you don't underwrite things.
Oh, that's clear. And Bart, I know you talked about it a bit before, but what are your thoughts on this point?
So I think it's twofold. The first one is just helping the operations, making things smoother, faster, doing reconciliation, all those things where in the past an awful lot of labor was thrown against to get it resolved. It can be done so much quicker, but inclusive things like KYC and so on. So automation to help the friction within the business we are in. The other thing is actually, and you don't need to push it too far, but I would call that data-driven finance. Ultimately, in many cases, a 90-day invoice can only be financed for the last, 30 days, because it takes 60 days before it gets legally approved. Whereas actually, if you would have insight in the ERP system of your customer, you could have seen that everything was lined up and there were only green flags. There was a purchase order, the goods were delivered, it was in the warehouse, it was checked. So all the steps were there, and it had a crazy high likelihood of becoming an approved invoice. So why wait until somebody presses a button if all the signs are green? I think what you will start to see is that the data insight of supply chains is starting to bring comfort for more and earlier financing at different stages. And again, if people are looking for alpha, that is very interesting, because you will take additional risks because it might not be legally 100% approved, but historically you can see that from this buyer to that supplier, if it reaches a certain stage, it is 98% of the times it will get approved. So that is slowly starting to happen. What I see in that area is that especially non-traditional funders are interested. They are used to make data-driven decisions, whilst I would say the incumbents are more asking, where is the legal document? And then you say, I don't have one, but I have an algorithm. And of course, I'm putting it a bit black and white. But I think that will be the next evolution, that is sort of starting to appear, not even at the horizon. I think it's close to by, and it is already happening in low volumes. And that can be a very interesting extra thing that fintechs can bring to this marketplace.
That's a really interesting perspective, Bart. Thanks very much. Well, look, we'll wrap up the panel discussion now. We're going to move first of all to a second poll question, and then take questions from our attendees. The second poll question is now up on the screen in front of you, and we're asking whether any of you who've attended the session today have ever worked on a transaction where a non-bank funder has been involved, because obviously we've been talking a lot about their growing involvement in the sector, but it's still a small proportion of the overall funding that takes place in the working capital financing space. So be really keen to get your responses and see how many of you are either already being involved, or have already been involved in a transaction involving a non-bank funder, not been involved, or not yet, but this year that could change in your view, given the sorts of transactions you're involved in whatever perspective, if you like. So just give you a few more seconds to respond to the question, and then we'll put the results up on the screen for people. But just as I say, keen to get your perspective and see how many more opportunities therefore perhaps there are out there for Casey and Bart to get involved in. So the poll is here. Now that is a really interesting response, and much higher than I must admit I would have expected. So over half of you who've attended the session today have been involved in a working capital financing transaction where a non-bank funder has been involved. And if we add in the not yet, but this year, that's roughly 2/3 of our attendees who are still with us at this point today. Dan, thanks very much for putting that poll up on the screen. We can take that down, I think, now. Thank you. So what we're going to do now is turn to any questions that we've had in, some of which will have been submitted while the attendees have been listening. I've got a first question that's come up here, perhaps unsurprising, a bit of a sort of a theme of today. So the question from one of our audience attendees is on the topic of ESG, and a question really saying, is that an important factor for you in the transactions that you work on and provide? So a bit of a flavour of the month topic. Casey, what does ESG mean in the context of working capital financing? Is a criteria you use it as an inhibitor? What would you say?
Yeah, I think there's certain industries that we out of principle won't do won't fund. We don't have a formalized ESG process for working capital, although I think it's a really, really interesting subject as ESG evolves, because you as a company might have an ESG policy, but yet your suppliers might not be adhering to said policy. So it's actually come up a handful of times from both internally and investors, and I think you'll see some more focus on that from an investor standpoint, which I think could have some positive repercussions. At this point, it's just there's not a formalized system, so it would be a little bit disingenuous to say it's something's ESG on our side if we can't actually affirm or confirm that it actually is adhering to those principles. So you can sort of do high level and say I won't touch a certain industry, but you don't know again if some supplier again in another country or even the U.S. you really have to underwrite them or have a real policy around it. So that's what we found is the gating issue right now is a real formalized process and affirmation process.
Yeah. Okay. That's clear. Bart, what's Pemberton's perspective on this point?
So ESG is really important for us and also for our LPs. It comes up constantly. We do have a policy. We have very clear guidelines where we can use the money for and where not. I like it. I think it's a good thing that's at least making sure that finance is contributing to the direction the world should be traveling to.
Okay, that's clear. Thank you. I've got a few questions coming in from the audience, but any others, please do feel free to submit them via the tab that you can see on the screen there. A second question I've had come in. We've talked a bit about and it reflects perhaps the audience we've got attending today, but about the idea that perhaps non-bank investors represent something different from banks. But of course, I guess there is the potential for them to be complementary or collaborative indeed around deals and transactions. And so a question from the audience is, have you ever worked on a deal inside the organization that you work in where you've in some sense partnered with a bank to bring a financing to a transaction, either for taking a different slice of risk or a component perhaps of the debtor book? I'm interested to see if that's something you've done or indeed had presented to you by the partners that you work with. Casey.
Yes, absolutely. We work closely with banks and view them as partners. I think, again, where their focus tends to be is historically more that Fortune 500. And there's a little bit of a balance too, where banks are funding for their own balance sheet at times as well. So while it's collaborative, there is some competition. So we're going to see what they have, capacity for to bring us on, and that might be in the form of, again, for capital reasons, or that might just be risk reasons, et cetera. But we've worked and done transactions with several banks, and we've also done some unique structures, to your point, where we've had, a senior and a mezz tranche, and we've had the ability to work with the bank to slice things up, and that worked for them from a capital treatment for a client. They wanted to make sure they were satisfying their need, and if they did it outright, it wouldn't have worked. So we've been able to step in at mezz at times. We've been able to work as senior, and we've been able to do 0 to 100. But we definitely look at it as a partnership. And the other part I would say is what I think we offer the non-bank funders for banks too is we can do the transactions you can't at times which does enable you to keep your arms around those maybe smaller companies or lower rated companies. And we all know how these companies grow and evolve, and how those ratings and risk spectrums can change. Looking at Netflix, which was a small company, a junk rated company, now it's on its way to investment grade. We can be very early in that, and we're fine doing that via participation. Let the bank own the relationship, and hopefully it grows, with them.
That's clear. Thank you. Bart, what about your perspective on that point?
Very, very similar. Both from joining forces at the beginning, trying to set up a club funding, to just buy secondaries and help banks to manage their balance sheet. And I think both of them are having absolutely the place in the system. There's nothing wrong with that. And I think more and more banks are now realizing that the asset managers are playing an important and vital role in this whole ecosystem. And it is not so much, oh, we are competition. It's just an additional capacity that comes to the market, and it serves a need.
Yeah. Okay. That's
I would have actually been on calls, not just with banks, with others, where we're talking to companies themselves and who we are and what we bring and how we look at the relationship. So we've actually been brought into those conversations where they're introducing us.
Okay. No, that's really good to I think it's a really positive note to end on, because we're just about to run out of time. Is that very much thinking of your organizations and the way you want to approach this business as having a lot of complementarity to the sorts of areas that banks, the traditional funders, if you like, have been operating in. So it just leaves me to say a couple of things. So if we didn't get to your question today, apologies that we've run up against the hour that we'd set aside for this session. As Dan, my colleague, mentioned earlier, we will be sending through a link with the video link, if you like, to enable you to see the recording of this session that we've run today. And last but by no means least, to say a really great thank you to Bart and to Casey for your contributions to this discussion today. I'm sure many of the attendees, albeit more than we thought, have had interaction with non-bank funders. I would have been really interested to hear your perspectives and hopefully may one day become, in some cases, borrowers in transactions that you guys get to fund. So thanks to all of you. Thanks to all of our attendees today who've joined this session. And goodbye for now. Thank you.
Thank you.
Bye-bye.